So the quarter that we've just experienced was really typified by a continued adjustment to the new market environment. The period that we had in 2022 was very, very negative as monetary policy tightened with interest rates going up. The start of 2023 has been a bit of a reversal of some of that trend, particularly for the tech stocks, where those AI developments, the emergence of things like ChatGPT, really drove focus and indeed sentiment for those mega cap tech stocks. You do expect almost a pendulum effect where you over adjust one way and then you have to swing back. And so this quarter we saw some of those valuation metrics come back for those large tech stocks, and of course because they led the market up, it's reasonable to see them leading it down. The uncertainty should continue for some time. Markets are still having to adjust on a multi-level layer because they are dynamic systems. We're expecting volatility to remain elevated, but we are expecting to start seeing things progressing towards the end of the year to seeing what the next period of stability might start to look like. One of the things that's adding a bit of a headwind to market is the rapid increase in oil prices. We've seen very, very high petrol prices at the pumps. Oil price spikes have historically been associated with recessions. It can quite often be the thing that tips an environment over the edge. So for us, the real issue about oil prices being elevated at the moment, or at least starting to move up and heading towards $100 again, really does put at risk the efforts that central banks have been making to tame inflation. I guess the real risk, the thing that we would be concerned about with higher oil prices, would be the fact that it might mean that interest rates might have to go even higher, or at least when we think about the higher for longer type mentality, it might make that longer even longer. The Chinese government are stepping in to some extent to stem the main issues coming from the stress in the property market. Any situation where the Chinese economy is in trouble is not going to be good for the rest of us. The building sector in China is a very large component of their total output. As well as that, it's very, very ingrained into the psyche of the population, so much so that 80 to 90% of household savings go into property investments. With the property market under such strain in China, that's going to impact the Chinese consumer and their confidence about the economy. For some people, it's actually the consensus view that the US will achieve a soft landing. We're not necessarily convicted of that point. Whilst we can see some wisdom in the people who are advocating a soft landing, historically soft landings have been very rare. It's very hard to change monetary policy right at the right point to bring in inflation as they want to do, but at the same point not kill growth. So it remains to be seen.